Hey option traders, for today's trade, we're looking at a bearish option play in electric vehicle maker Tesla. The stock has been on a decline since early April and is sitting below the 2150 and 200-day moving averages. Today, we're going to look at how to set up a bearish option income trade called a bear call spread. Looking at Tesla on MarketSmith, it's clear that a cup with handle formed amid the market pullback starting in January. A handle started to form in April, but just kept on forming and hasn't stopped, which is not ideal. The handle now has a depth of 33%, which is quite deep relative to the cup's depth of 42%. Last week, shares also slid below important levels of support, which suggest institutional distribution in the stock. Weakness in the stock's relative strength line is also a bearish signal. With the stock below key levels of support, you could consider putting on a bearish risk-defined strategy known as a bear call spread. A bear call spread is an excellent strategy for beginners and is used when investors expect the underlying stock price to fall. Remember, with options, there are two types of options, calls and puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. A bear call spread is a credit spread, which means you'll collect a premium upfront for initiating the trade. So for this trade, we're both buying a call with a given strike price and selling a call with a lower strike price simultaneously, and together they create the spread. Both calls are on the same stock and have the same expiration date, but the difference in strike prices creates a range. The investor can expect a profit or a loss based on where the stock finishes within that range upon the option's expiration date. For the bear call spread, we expect the stock to go down between now and the option's expiration. The investor nets a credit for putting on this trade, meaning you are paid upfront. Since calls lose value as the underlying stock falls, both options would expire worthless if the underlying price finishes below the lower call strike. Here, the maximum profit would be achieved and would be the total premium you initially received. But on the downside, if the stock price moves above the higher strike call option, both call options would have lost money, and the maximum loss for the strategy is realized. It's important to know your potential gain, loss, and break-even points for the trade. This will depend on the width between the two strike prices of the calls in the spread. For example, buying a 70 call and selling a 65 call creates a spread that is $5 wide. If the bear call spread collects $1 of credit, the maximum gain is $1 times the 100 shares of stock each option contract represents. So the maximum gain would be $100 if the stock price is below the short call at expiration. The maximum loss would be $400 if the stock price is above the long call at expiration. For this, just take the spread width minus the premium received, and there you have your max loss. The break-even point would be the short call strike plus the premium received. So let's talk about a couple of rules for taking profits. First, if the trade has achieved a profit equal to 50% of the premium received, that can be a great time to take profits and move on to the next opportunity. This is particularly true if the profit comes in the first half of the trade. On the other hand, when a bear call spread moves against you, don't allow the loss to get bigger than 1.5 to 2 times the premium received. A second rule to consider is rolling a losing trade out in time to the next expiration. The next expiration could be a weekly or a monthly option. The main thing to remember is that you only want to roll for a credit. Rolling out in time means tying up precious capital for another week or even a month. So it's essential to receive a net credit for the extra risk being taken. All right, with all that said, let's look at my trading platform and set up this trade. So here we are on my Thinkorswim dashboard, and TSLA is the ticker symbol. You're going to want to select vertical in this box here, which is the spread type for today. As usual, we have our strike prices here in the middle, and we're just going to select the 975-980 strike pair. We're going to be looking at this side of the screen for calls. And down here, I've got the trade ready to go. We're selling a June 17th 975 call, and we're buying a June 17th 980 call. We're looking at selling the June 17 975 call and buying the June 17 980 call to create the spread. Selling these two options generates roughly $55 in premium. The trade is a maximum risk of $445, and the spread will achieve max profit if the stock closes below 975 on June 17th, in which case the spread would expire worthless, allowing the trader to keep the $55 option premium. The max loss would occur if Tesla closes above 980 on June 17th, which would see the premium seller lose $445 on the trade. A stop loss could be set if Tesla trades above 900 or if the spread value rises from 55 cents to $1.10. As this is a bearish position, if you think Tesla's going to go higher, don't enter this trade. And as always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And always remember that options are complex and investors can lose 100% or more of their investment depending on the strategy. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.